The Minority Market. Episode 70. Support and Resistance in Human Behavior Context. Most people learn support and resistance as horizontal lines on a chart. They draw lines, mark zones, and treat them like mathematical levels. The minority understands something deeper. Support and resistance are not lines. They are zones of human behavior. They exist because people remember, react, fear, hope, and repeat patterns. Markets are not driven by charts. Charts only visualize collective human decisions. Every support level represents an area where buyers previously felt confident. Every resistance level represents an area where sellers previously felt pressure. These levels exist because memory exists. Traders remember pain, profit, regret, and opportunity. When price approaches a previous support zone, buyers remember past success. They feel confidence and re-enter. Sellers hesitate because they remember price bouncing earlier. This collective hesitation creates demand. The level holds not because of magic. It holds because of human memory and behavior. Resistance works the same way. When price approaches previous highs, sellers remember profit-taking zones. Buyers remember rejection points. Fear of loss increases. Greed turns into caution. This emotional reaction creates selling pressure. The minority understands that these zones are not exact numbers. They are behavioral areas. Price may overshoot slightly. It may fake breakouts. It may test zones multiple times. Beginners expect perfection. The minority expects imperfection because humans are imperfect. Another important insight is role reversal. When resistance breaks strongly, it often becomes support. Why? Because previous sellers become buyers. People who missed the breakout wait for pullbacks. Those who sold earlier want re-entry. This shift in psychology transforms behavior at the same price zone. Support and resistance also reflect institutional activity. Large players accumulate positions slowly near support zones. They distribute near resistance zones. Retail traders see only candles. Institutions see liquidity pools. This is why price often consolidates near important zones. Accumulation and distribution take time. The minority also understands false breakouts. Emotional traders chase breakouts aggressively. Institutions often use this liquidity to exit or enter positions quietly. Price then reverses, trapping emotional participants. Recognizing this behavior reduces impulsive entries. Another key concept is time frame context. A support zone on a daily chart carries more behavioral weight than one on a 5-minute chart. Long-term participants operate on higher time frames. The minority always respects larger context before reacting to small movements. Support and resistance are also dynamic. Moving averages, trend lines, and channels represent evolving behavioral zones. As trends develop, buyers and sellers adjust expectations. These dynamic areas act as psychological reference points. Volume also plays a role. Strong reactions near zones combined with high volume indicate strong emotional participation. Weak reactions with low volume often signal indecision. Observing this combination improves decision quality. The minority does not blindly buy at support or sell at resistance. They observe behavior around these zones. Is price slowing down? Is momentum weakening? Is rejection visible? Is acceptance happening above levels? These clues reveal intent. Support and resistance are not trading signals. They are context tools. They help you understand where attention is focused, where emotions rise, where decisions become crowded. Another powerful insight is that these zones exist because humans repeat mistakes. People buy late, sell early, chase trends, and panic repeatedly. Markets exploit these repetitive behaviors. The minority does not fight this reality. They learn from it. Over time, when you study charts with behavioral understanding, patterns become clearer. You stop seeing random movement. You start seeing fear zones, greed zones, hesitation zones, and decision points. This understanding reduces emotional reaction. Instead of panicking at volatility, you recognize it as behavioral testing. Instead of chasing breakouts blindly, you wait for confirmation and structure. Support and resistance teach patience. They teach discipline. They teach observation. They train you to think slowly in a fast-moving environment. Remember, price levels matter not because of mathematics, but because of memory. Markets are psychological ecosystems. When you understand this, your decisions become calmer and more strategic. The minority does not worship indicators. They study behavior. They read emotions through price. They respect zones not as lines, but as stories of past actions. This shift in thinking transforms technical analysis from mechanical drawing into behavioral interpretation. In the next episode, we will explore how market psychology creates trends and why trends persist longer than most people expect.